Okay, I am going to answer some of the questions that each of you had on the last forum. Specifically, Chapter 6 homework on ending inventory and cost of goods sold. So I picked a few of those. There are a couple questions on this, so I'm trying to answer them all with one. I'll talk about the allowance, debit and credit balance. I'll talk about contra assets, debit or credit, bank statements, wire deposits, credited, checks, and decreases debited. Why does the sale of securities with a gain not affect income? That's actually, it does affect income, but why is the direct write-off method used for calculating income taxes? So I'm going to try to answer all of those. There was one other question that asked about reopening one of the homeworks, and I'm going to pause this while I take you to a homework site. Okay, this is your homework site, and when I set these up, this is what it looks like on my screen. I'm not sure, I can check, and it looks a little different on your screen, but this is how it looks on my screen. But when I set these up, I click a button that says that you can look at the answers, or all the answers are given after the due date. So I was under the impression you can see them after the due date. I would like some feedback on that as far as what you're not seeing, but I don't have the answers before the due date, it's after. However, if you notice here, I have Chapter 6 practice, same as Part 1, so let me switch to student video here. Okay, so Chapter 5, 6, all right. So it is Chapter 6 practice, same as Part 1. So I just basically took all of these problems in Part 1 and put them back in as practice. So this is practice. If you go over to the right, I don't have that screen capturing right set up there, but you can see that instead of marked homework over here past the screen, on yours is practice. So anyway, you can redo Chapter 6, but I really think you should be able to have access to Part 1 and Part 2 after the due date. That's what it seemed like the setting was. But again, I can see a lot of things that you can see, but a few things I can't. Like, I can open up these homework problems whenever I want. So if you're telling me you're not seeing them, I'm not really sure if you haven't tried or if there's an issue. So let's go back to that's the first question answered. Go back to the Excel spreadsheet. Okay, so the first thing that I want to do is talk about cost of goods sold and ending inventory. My suggestion to you would be to set up an income statement, and you should know this. You should be able to just type out an income statement really quick. So sales minus cost of goods sold gives us gross profit, minus operating expenses gives us net income. Income statements go on down with taxes, etc. But for this class, this is pretty much what it is. Sales minus cost of goods sold is gross profit minus operating expenses equals net income. You should also be able to know by heart the cost of goods sold statement. So the cost of goods sold statement, this is the title there, I'll make it bold if I can, is beginning inventory plus purchases gives us available minus ending inventory is cost of goods sold. So I'd like you to think about it like this. If you start the semester with 1 pencil and I give you 7 more and you have 3 left, how many did you use? Well, some of you may say, okay, if I start the semester with 1 pencil, I gave you 7 more, I have 8 pencils available, and if I have 3 left, then I use 5 pencils. So, beginning inventory, what I started with, plus what I added gives me purchases. That gives me 16,100,000 available. I subtract my ending inventory, and that's cost of goods sold. So basically, I'm going to have these particular ones blank. I'm going to delete these things. Okay, so then I'm going to say, okay, I'm just going to start plugging in the numbers. So I use a perpetual inventory. On January 1st, its inventory had a beginning balance of $6,700,000. I purchased merchandise for $9.4 million. I had sales of 26 million. I'll type these back in next time. I recorded inventory shrinkage of 10,000 after taking physical inventory count. You may say, well, where does that go? And so I'm just going to leave it out for a second. And I reported gross profit for the year, right here, of 17 million. Okay, well, I know sales minus cost of goods sold is gross profit, so I can back into my cost of goods sold. And so I know that 26 million minus some number equals 1.7 million. So I've backed into cost of goods sold. So cost of goods sold is 24. Typed in a number wrong. Let me pause. Okay, I fixed it. I typed in 1,700,000 instead of 17 million. So if I had sales of 26 million and gross profit of 17 million, 26 minus some number equals 17, and that number is 9. So now that I know I backed into cost of goods sold, I can put that number right there. Okay, and now I need to figure out ending inventory. So I know beginning inventory plus purchases equals available. And I know that I had 1.6 million available, and I know my cost of goods sold was 9 million. So now I can back into my ending inventory. So I have my ending inventory of 7,100,000. So you can see I've figured out this line and this line simply by writing out these statements and plugging in the difference. Okay, now what they're asking, the next one, see, immediately prior to recording the inventory shrinkage at the end of the year, what was the balance in the cost of goods sold account? So I know that I ended up with 7,100,000 right there. I'm just bringing that number there. So this is my ending inventory, and here's my cost of goods sold. Okay, so I know I had inventory shrinkage. So inventory shrank and ended up with 7.1 million. Okay, I went and counted it and got 7.1 million, and I know that inventory was lower than it was on my books because it shrank. Inventory shrinkage, theft, loss, spoilage, that type of thing. So it must have been 7,110,000 before. And then we also know that if I have 16.1 million available, so if it's not an ending inventory, it's cost of goods sold. So it's either here or not here. So these numbers are going to go the opposite way. So if this one was higher, this one has to be lower. And so I have 9 million minus the 10,000, so I have 8,990,000. Okay? I can also do similar things with this problem. So in this problem, I'm just going to take one line, and I've done the same thing. So notice I've got sales minus cost of goods sold is gross profit minus operating expenses net income. If you don't know that, you will need that throughout your business life. So just write it down until you know it. Your cost of goods sold statement, you also will need to know this one. Beginning inventory plus purchases equals available minus ending inventory is cost of goods sold. Okay, and then the cost of goods sold feeds into there. So these are important things. All right, so we're given A, B, C, D, E scenarios. And quite frankly, all you do is plug in the numbers I know to determine the numbers that I don't know. So again, I'm going to delete these. Okay, so in this one, I'm not given cost of goods sold, or I'm not given these cells with the little blue arrow in it. Those are the unknowns in your homework problem, but I just pulled out the answer so you can see it. So I have net sales of 270,000. Okay, my next one is beginning inventory, 76,000. My net purchases are 104. So now I can add up my beginning inventory plus purchases to get my available. Tells me my ending inventory is 35,200. So now I can take my available minus ending inventory to get my cost of goods sold. That cost of goods sold comes up here. So I know that sales minus cost of goods sold is gross profit. They've already They also give me my expenses of $72,000. So now I can back into net income. Oops. And now my unknowns were cost of goods sold. Yep, I have 144.8, and my net income was 53.2. I'll just do one other one. And you can do these by hand. There's nothing magical about this, except it was just easier to show you on the computer screen because I have or just screen capture software. So 570,000. My beginning inventory is 79,000. My net purchases are 290,000. I'm not given ending inventory. I am given cost of goods sold. So this is the same cost of goods sold. I'm not given gross profit. I'm not given expenses, but I am given net income. Okay, so now what I have to do is back into things. So I know that beginning inventory plus purchases gives us available, and 369 minus some number gives us 264. So 369 minus 105 is 264. I know that sales minus cost of goods sold is gross profit, and then I know 306 minus some number gives us 20,000, so that's 286. So let's see if I got them. My ending inventory is indeed 105. I just proved that. Next one was gross profit of 306. I got that. And expenses are 286. And you can practice these with the other three and get the numbers there. So that's how ending inventory and cost of goods sold works. And I know we had a few questions on that one. Okay, I'm going to do it one more time with exercise 6.3. Notice how repetitive this is. So far I've had 3 questions that I can answer with this. Okay, so I'm going to do the same thing with this one, but I'm going to delete these numbers. Okay, so I have merchandise inventory at the beginning of the year is 79 million. I have merchandise inventory at the end of the year is 91 million. I know net sales for the year were 2.46 billion. And I know gross profit margin is 13%. So I just put that 0.13 right there. Okay, so gross profit margin is 13%, which means gross profit is 13% of sales. So basically what they're saying is, think of it this way. If you stick $1 in a machine, we'll say soda machine, we'll pretend they're selling soda for $1. If you sell, put $1 in a soda machine, sales are always 100%, then gross profit for every dollar is 13 cents of every dollar. So 13% gross profit margin means 13 cents on every dollar's gross profit. Okay, so the question asks for cost of goods sold and purchases. So in this particular problem, I don't need my operating expenses or net income because they don't ask for those questions. So basically what I want to know is I want cost of goods sold and purchases. So I want this number and I want this number, okay? Well, if I know that there's actually 2 ways I can get this number. I can get the 13%, and then I can back into cost of goods sold, or I could do it this way. If this one's 100%, and this one's 13%, okay, then I know cost of goods sold is the other portion. So 100 minus 13%. 87%. So I could say, okay, well, if gross profit is 13%, then the cost of the items is 87%. So 87 cents on the dollar goes to cover the cost of goods sold, and 13 cents goes towards covering the rest of the stuff. So it's pretty small gross profit margin there. Okay, but now I know my cost of goods sold is $2,140,000. So if some number minus ending inventory is $2,140,200, so this number, and this is just basic, very, very basic math, so back in grade school math, so you can figure those out. So then I know that beginning inventory plus some number gives me available. So this number must be all but the 79 million. So I have 2,152,000. So that one comes right in there. Okay. So I'm going to pause this and look at my other questions for a second. Okay. So I'm going to call this one answered. So I'm going to delete that one. Now I'm to the allowance account. When does it have a debit and credit balance? Okay. And I think I understood the question that was asked, but let me go through this. When we set up the allowance based on the estimate, we debit bad debt expense and credit the allowance. There are two methods to do that. The two methods are, we're going to look at sales, and I've gone through this in another video, so I'm not going to really go through it in detail, and based on accounts receivable. Okay, when I base it on sales, my focus is how much needs to go in bad debt expense. And the allowance just comes along for the ride. So whatever goes in the allowance goes in the allowance. The second one is I look at accounts receivable. And when I look at accounts receivable, I'm determining how much goes in the allowance. So I'm going to focus on the one that looks at accounts receivable, because that's the one that the debit and the credit balance and the allowance makes a big difference. Okay, so I've determined this is year one. I have never been in business before, so I started business on January 1st, 2018. Okay, so at December 31st, 2018, I want my 2018 financial statements to be correct. So I look at my accounts receivable and I age them, and I determine that $20,000 should be in the allowance. So notice I credit it. Okay, I do this on December 31st. Okay, so of my accounts receivable, I don't know what my balance in accounts receivable is, but maybe my balance in accounts receivable is $300,000. Okay, so I've determined that $20,000 of my $300,000 will go back. Okay, so that's a little less than 10%. So maybe that's high, I don't know. Okay, so here's my accounts receivable. So the net realizable value of accounts receivable is my balance in accounts receivable. Okay, my balance in accounts receivable less my allowance. So, I've got 280,000 is my net realizable value. So that means the net cash I think I'm going to collect of my 300,000 is all but 20,000. Okay, so then that's December 31st, 2018. This expense goes on my income statement. My net realizable value on my December 31st balance sheet is 280,000. During 2019, I write off some accounts. So let's say I write off a $1,000 account because they went bankrupt. There's my journal entry. So notice I debit the allowance. Okay? And I keep writing them off. So I write off a $2,000 account, etc. So all through 2019, I write off the accounts. So let me total these up here. Pause it a second. So notice at this point in time, I've written off 3,000 accounts, and I have 20,000. I put 20,000 in the allowance. So this side adds up to 20,000, and I have 3,000. So this, at this point in time, I have 17,000 left. Okay. So if I write off another 5,000 account, etc., etc. So let's go down here and let's me put in 10,000. Okay, so now I'm back to the end of 2019. 2018, I made an estimate. Next year, I wrote them off. Here, I have a credit balance in the allowance. So next year, when I go and make this journal entry, bad debt expense, and I credit the allowance, this entry, but the next year, I look at my accounts receivable, and I determine I want, I don't know, let's say $25,000 in the allowance this year because of the aging of my accounts receivable. So I'm going to draw a line here. Okay, so I want $25,000. The allowance is a contra account, so I always want the ending balance to be a credit. So notice that I've got $2,000 in it already. I want it to go up to $25,000, so I need $23,000 in my allowance. Okay, so $2,000 balance plus $23,000 I added, so my entry is $23,000. But let's take alternative 2. What happens if I write off? So notice in this case I wrote off $18,000, but I estimated $20,000. What happens if I write off $22,000? Whoops. Okay, so notice if I write off $22,000, I have $22,000 in my write-offs, but I only estimated $20,000. So by year end, I have a debit balance in my allowance for doubtful accounts. So notice I just added up these. I'm just doing it because it's on Excel. So this is what this side, my write-off side, my estimate side, write-offs. So I had more write-offs than I thought I was going to have. So I ended up with a debit balance. I still look at my accounts receivable and determine that I need $25,000 in it. But notice I'm $2,000 in the hole, so that makes this entry $27,000. Okay? And then, since I have $25,000, next year I'll write them off and determine the balance in the end of the allowance, determine what I want it to be. I want it to be $25,000 again. I will bump it up to $25,000 from, if it's a debit balance, it's in the hole. So I need to bring it out of the hole, $2,000, and up to $25,000. So I need to add $27,000. Okay. If I was the other way, if I had the balance on this side, if that side was more, then I only need $23,000. Okay. So hopefully that answers your question. Allowance for debit and credit. Will it ever have a debit balance? Only temporarily. It will have, always has a credit balance after I get done doing this entry. But this entry is generally only done on December 31st. Okay, so if before December 31st I had more write-offs than I estimated, it will have a debit balance and I need to make my journal entry bigger. Okay, so I'm going to call that one good. Hopefully that's what it answered that. Contra asset. Contra assets, contra means opposite. So an asset has a debit balance, so a contra asset always has a credit balance. By definition, opposite asset. Assets have debit balance, so contra assets have credit balance. So that's that one. Let me pause that one to read the question again on the bank statement. Okay, so I'm not necessarily sure if I completely understand this question. For the bank statement, why are deposits credited and decreases debited? The only thing I can think of is this is not a debit and a credit column. This is a statement. Okay, it just happens to have two columns. They indent these because they want to show the total over here. So our outstanding checks, if I put them all in one column, it just becomes messy and cluttery because I'd have to subtract them all. So whenever I want the total shown, I just move it over. You'll have statements that have 4 and 5 and 6 columns. So what I have to do for a bank reconciliation is I have to make journal entries for the books. I don't ever make journal entries for the bank. So notice this has what our cash account says is $18,000, and then I have service charges. Well, service charges are a decrease in cash, so I'm going to debit service charge expense. So I'll debit service charge expense for 21, and this one is a Jane Jones check return for not sufficient funds. So I'm going to try to get a hold of James Jones and collect the money from her because she didn't pay me. She paid me a fake check, not a real check. So $850, and now I have to credit cash because cash is going down to the correct balance of $17,129. Okay, so let me talk a little bit about internal control. You generally don't do these personally because you keep your own cash records and you write your own checks. But in a business, the person who writes the checks will never reconcile the bank account. The reason they will never reconcile the bank account is because if they're stealing money, they can hide it if they do the reconciliation. If somebody else does the reconciliation, they'll find it. So let's pretend you're the bookkeeper, you're doing the journal entries, you're the accountant, and I'm going to reconcile your bank account that you're keeping, okay? So I'm just basically verifying that everything's kosher and you didn't write checks to yourself, which is how a lot of funds are stolen in small businesses. People just write checks to themselves, and since they reconcile the bank account, nobody ever sees it, okay? So I'm going to reconcile the bank account. I cannot make journal entries because then I could hide things. So I just do the bank reconciliation and you say, hey, we have $18,000 in our bank account. Okay, and then I go through the bank statement and see, okay, well, they charged us a service charge and we haven't recorded that yet. And it makes sense that we haven't recorded it yet because sometimes you don't know the service charge until you get the bank statement. And I see there was a bounced check in there that came back because James Jones's account didn't have enough money. All right, so then I do that and say, okay, well, this agrees with that. So everything is kosher. You did a great job. Everything is all right. But remember, I can't make these journal entries, and these are things we didn't know about, so we need to record them. So I hand this back to you and say everything is okay, and I sign off on it. And I say, now you need to make these 2 entries. So you need to make these 2 entries because cash is not $18,000, it's $17,129. And if I make the entry, it is that. So my guess is you were thinking this is a debit and a credit column, and it's not. But I'll pause here. Okay, the next one, why does the sale of securities with a gain not affect income? That's not a true statement. It does affect net income. So if you look at this particular problem right down here, I had securities on my books for $180. I sold them for $520. So I get them off my books for $180. I debit the cash, and there's your gain, and that gain goes into the income statement. So it does affect net income. And the last question is a good question here. Why is the direct write-off method used for calculating income tax? And the reason that is really that is because the IRS says so. I don't know for 100% why the IRS uses the direct write-off method instead of the allowance method, but it's generally assumed it's because the direct write-off method uses an estimate, and the IRS would prefer to not use an estimate, so they say you can only write off an account once you 100% know who it is and what account you're writing off. So they would have to file bankruptcy before the IRS would let you write it off. So it's more knowable, is my guess on it. And that's what most accountants feel, that the direct write-off method is only used for tax purposes because the IRS, where they can prevent you from guessing, they want to prevent you from guessing. So I hope that all helps. 30 minutes already, so I'm going to sign out. Hopefully I helped on those questions.